really the big thing we're going to talk about and learn. So to do that, they give us some pretty good examples to follow along in the PowerPoint. So that's what we'll spend most of our time doing. As usual, the book has many examples and definitions, and I'll point a few of those out as we go through this PowerPoint, but just make sure you're looking at the book and reading what is there also, because you will definitely find some very good sources there. This company, we're going back to the company we looked at in previous chapters, DeLeon Company. They were having some bad times when we previously looked at them, and hopefully they've turned some things around based on what they wanted to project, and we'll see if that's going to work out for them or not. And you can see that I've got a partial balance sheet here. I've got just the asset section, and I've got some numbers here. You can see that cash has gone up a lot. My account receivable has gone up a little bit. Inventories have gone up. Total current assets has gone up a lot. Gross fixed assets has gone down just a little bit. Depreciation's gone up mostly just as depreciation's gone up. Looks like then maybe some of our gross fixed assets we maybe disposed of a few things. So in net, our total assets has gone up over the previous year. We take a look at our liability side. We can see that accounts payable has gone down. Accruals have gone down. Notes payable has gone down. Looks like we paid off some debt. Long-term debt's gone down. Again, we paid off some long-term debt. Common stock has gone up a lot. Looks like more than almost 1.3 million. And retained earnings has taken a nice jump, a nice increase there also. Income statement, sales went up by about $1 million. Cost of sales went up only $350,000, so that's a nice, those are some nice numbers there. Sales went up $1 million, but cost of goods sold didn't go up nearly as large. Other expenses went up a little bit. Our EBITDA is positive. Remember, that stands for earnings before interest, taxes, depreciation, and amortization. My depreciation is the same as it was the previous year. My EBIT has a nice big positive now. My interest expense is down, which makes sense based on paying off some of our debt. My earnings before tax is a nice positive. I've got a tax bill and a positive net income and a nice turn from last year, but almost a little over a $400,000 increase in improvement from the previous year. The number of shares outstanding has gone up a lot. Looks like we issued 150,000 shares. My earnings per share went from a negative to a positive. Dividends per share went to 22 cents. My stock price took a nice big increase over almost $10. My lease payments are still $40,000. So why do we use ratios? And the whole point with ratio analysis is to try to standardize the numbers and facilitate comparison. And really, ratios work when we're comparing something to something. And so that could be comparing our company's data to another company, a company that we're a key competitor with. It could be comparing to industry averages, or it could be comparing to our own company over a period of time. And comparing over a period of time is just simply a trend analysis. Okay, there's 5 major categories of ratios, and they will all give us some specific information. Liquidity is basically, can we make our cash payments? Can we pay our bills on time? Asset management, do we have the right ratio of assets compared to sales? Debt management, do we have a good mix of debt and equity? Profitability, how profitable are we in terms of taking a sale and turning it into net income in terms of increasing return on assets, profitability management, and return on equity. Then market value is, do investors like what they see in terms of our price to earnings ratio and our market to book ratios. So what they're going to do now with many of these slides is just take the data given to us when we look at the balance sheet and income statement for DeLeon and compute the ratios and just do an analysis between the 2 years and then determine, did it improve, did it get worse, or is it flat? And so we're kind of doing a little bit of a trend analysis here, but just with a 2-year data point. Trend analysis is really better when you probably look at 4 to 5 years, probably 5 years being the most, probably the best, just giving you that much perspective and history to see the results of your numbers over a period of time. And of course, that trend analysis should also help you determine how well have decisions that the company's made come to fruition. What kind of decisions were made at a strategic level, and then we kind of measure with ratio analysis the results of those decisions to figure out, did those decisions work, did they not work, and if they did or did not work, then the question should always be, why did they work or not work either? So you can see here they're just taking the current ratio, which is current asset divided by current liabilities. That's what it is for 17. You can see it's 2.34. It's actually a very healthy number. And the book, of course, goes on to take each of the 5 big categories of ratios, and then it breaks all these ratios down within each of the categories and explains them using a different set of data than the PowerPoints do. So always, again, look at those also. The current ratio is just basically, can we easily pay our current assets with, can we easily pay our current liabilities with the current assets that we have on hand? And that 234, think of it like this: if for every dollar of current liability, I have $2.34 of current asset on hand. So clearly that's pretty good. Quick ratio is current assets minus inventory. So we just take the inventory category out of our current assets, basically saying, we're not going to include those as easily turned into cash because we have to go through the process of selling inventory, then collecting on any receivables when we sell inventory on account. So we're going to just take that out and see what that number gets. So the quick ratio should leave cash left over, your AR left over. Those would be the big 2 categories. And that will typically be below 1. That's not unusual if that's below 1. And then what they're doing here is giving us a trend analysis. You can see they're giving us 3 years, 15, 16, and 17. And we looked at the 15 numbers in a previous chapter with Ford De Leon here. And you can see that the industry average is 2.7. And you can see that they had a huge increase from 16 to 17 for the good. They're still below the industry average. So they've got a ways to go, but there were a big improvement over 16 to 17. So the liquidity position is weak because the quick ratio also, while it did improve between 17 and 16, is still below the industry average. So they're not quite as liquid as other companies in their industry. However, they are still, on the upswing, which is important for them because they had such a terrible 16. So still kind of good news, and just to know that at least we're trending the right direction. Inventory turnover, basically it just tells us, inventory turnover tells us how quickly does our inventory turn over. Basically how many times do we sell at our store, fill it up, sell it out, fill it up, sell it out. Just kind of think of it like that. Now, of course, you never wait till your store is sold out before you refill it again. You're constantly stocking shelves and making sure you've got plenty of inventory on the shelves, but just that's kind of the concept behind it that I think makes the most sense. So just imagine that the store emptied and refilled 4.1 times in the year. So clearly the higher this number is, the more inventory they're selling, which is usually a good thing. You want sales, that's how you make your money. And you can see here what their numbers are, clearly trending down. Okay, so and way below the industry average. So they've got some work to do with inventory turnover, kind of telling us that their inventory management is not very good. Possibly they've got some old inventory that's just sitting there and not getting sold. Their control of inventory is poor, and they're trending down, and they're forecasting a trend that goes down. Days sales outstanding is the average number of days after making a sale before cash is received. So how long does it take us once we make a sale on account to actually collect the cash on that sale? And clearly the longer that time period is, the longer you're waiting to receive the cash. And good cash management, you'd want that number to be as low as possible. So they've given us here the formula. It's a very easy formula: receivables divided by annual sales divided by 365. And you get 45.55. They'll give us some analysis here of that, and you can see that it's actually getting worse. So they're way higher than they should be. Industry is 32 days. They've been between 37, 38, and now 45 days. That just tells us we've got a poor credit policy. And again, this ratio analysis is good for management because if they're staying on top of this and analyzing these ratios consistently, that gives them the ability to make decisions to improve them. So this one's trending the wrong direction. The shorter the better with this one. The quicker I get my cash, clearly, the better off a company is, the better off we are as individuals, the quicker we get our money. So they have a poor credit policy, so that might mean they need to get better at collecting. They need to reevaluate who they're granting credit to. So there's lots of questions that need to be asked about this, but something needs to change for them. Fixed asset and total asset turnover ratios. Basically, how efficient are we at using assets to turn them into sales? How good are we at taking our assets and saying, for so many assets we own, how many sales can we generate? So think like your property, plant, and equipment type assets, building machinery, vehicles, computers, furniture. The list goes on, but the big ticket fixed asset items are clearly your manufacturing capability, or if you are, as a manufacturer, or if you're a retailer, your stores, things like that. Okay, so how good are we at turning an asset into $1 of sales? And you can see that the sales divided by net fixed assets. So we had 8.61 more sales than fixed assets. And then our total asset turnover is just simply sales divided by all assets. So all assets includes all of our current assets. And we'll look at some trends with those. And you can see that fixed asset turnover is projected to exceed the industry average. So we're actually better. This is one of the few we're actually better than the industry at. We're better than the industry at taking $1 of fixed assets and turning that into sales. Okay, so and it's trending back in the right direction now. 16 was such a bad year. We recovered from 16 clearly, and we can still get better, hopefully get back to 15's levels, but we are above the industry average. For the total asset turnover, we're still below the industry average. Remember, this one included all assets, and we've got an unusually large number of inventory and a high amount of account receivable, which I call AR. And those two large numbers are bringing this down. You can see it's trending down very clearly and has been below the industry average. So again, we've got to get better at collections, reduce that AR number, and get better at managing inventory and reduce that number, and that would help those ratios. Debt to capital and times interest earns kind of deal with how much money can we borrow. As a bank looks at us, how much money might they be willing to lend to us. So debt to capital is just total debt divided by your invested capital. We get 26.39%. And TIE is times interest earned. TIE is your EBIT divided by interest. Your earnings before interest and tax divided by interest. You get a multiple of earnings to interest, and the higher that multiple, the better ability you have to be able to afford interest payments. So banks like these two ratios, and a bank does not want to loan money to a company that is highly leveraged, and that's what we're trying to measure with this 26.39%. So we can analyze those a little bit better, and we can see here that debt and total invested capital and TIE are better than the industry average for this company, believe it or not. And so, 16 they borrowed a lot of money. In 17 they paid a lot of that back because they issued stock and paid off some debt. So that got them back under the normal range and got them under the industry average. So, 26.39% of our assets have been basically bought with debt is one way to think about it, which is better than the industry. And our times interest earned is really good. We've got 7 times earnings over interest expense, which is better than the industry. So here's one where both of them are better than the industry, so one of the few. Profitability ratios, how good are we at taking $1 of sales and turning that into essentially earnings, net income. So EBIT is my earnings before interest and tax. My operating margin is EBIT divided by sales is 7%. So think of it like this: every $1 of sales turns into 7 cents of operating margin. Profit margin is net income divided by sales. Net income is after taxes, after interest, so it's a lower number than EBIT. That's 3.6%. and my basic earnings power is my EBIT divided by total assets of 14.09%. And again, if you look at just a ratio, look at a number, it really doesn't have any meaning until you compare it to something, which is why these slides have been useful, because now I can compare these numbers over time to my company, plus compare them to an industry average. So my operating margin, industry average is 7.3. I've been always below it, but however, I'm trending in the right direction and getting close. That's good. My profit margin was below industry average, really bad in 16. We know 16 was a bad year, but it came back and is now actually above the industry. My earnings power has always been below industry, but it is trending the right direction. Okay, so just overall, in terms of all these ratios we just looked at, that's kind of the whole point of ratio analysis, is to pull a few ratios out of each of the 5 categories, do some trending for your company over, they gave us 3 years here, compare that to something, industry average, a key competitor, and then draw some conclusions, and that should help management or investors or a bank learn about the company and be able to make some informed decisions and maybe some operating decisions and so on. So operating margin was not great in 16. We know that it was very bad. It was really, just not great is an understatement. It's very bad. We do project improvements in 17 based on some of the changes we know we need to make, but we're still below industry average. Profit margin, the second point, was also very bad in 16. The whole income statement was just really bad. But we expect to exceed the industry average in 17, so that's a good trend. Basic earnings power removes the effect of tax and financial leverage, and it's useful for comparison. And basic earnings power is projected to improve, but still below industry average, and there's room for improvement there. So, overall, 16 was an abysmal year for them. That expansion wasn't done the right way. It increased their costs too much relative to the extra sales that they were able to get. They made some changes between 16 and 17 that definitely were for the good. 17 is a projected year, but that's what they're planning for based on the changes. But they still have work to do. 17 should be a good year for them, but hopefully then by 18 they can implement some more things to make 18 even better. Would be kind of the way I would look at it. So a few more ratios here, return on asset, return on equity, and return on invested capital. So ROA is my net income divided by total assets. ROE is my net income divided by total common equity. Does not include preferred equity, just common equity. And my return on invested capital is my EBIT, tax affected, times 1 minus the tax rate divided by my invested capital. And you can see here ROA is improving, still below industry. ROE improving, but below industry. And ROIC, same thing, improving, but still below industry. So they're all trending back from the abysmal 16 that we had. Some of them are better than the last good year we had of 15. ROA is. The other two are still, or ROE is below 15's levels. ROIC is above 15's level, so that's good, but they're all trending the right way. They're all still significantly below the industry average, though, so there's lots of work we can do to get these up to the industry standards, which is what the goal would be of the company. So debt, the effect of debt on return on asset and return on equity. Holding assets constant. If debt increases as assets stay the same and debt increases, equity would go down because, remember, the accounting equation, this all has to balance. Interest expense increases, of course, as we borrow more money. We have more interest expense to pay. That would lower net income. As ROA declines due to the reduction in net income, ROE may increase or decrease since both net income and equity decline. Because remember, as assets stay the same and debt goes up, equity must come down, and again, as we have more interest expense, that reduces net income, which also has a negative impact on ROE potentially. So the question is the decrease in equity and the decrease in net income happening at the same rate? That would potentially either make this go up or down for ROE. So ROE, return on equity, ROE and shareholder wealth are correlated, but problems can arise when the ROE is the sole measure of performance. Okay, so just a few things to keep in mind. ROE does not consider risk. ROE does not consider the amount of capital invested to obtain the amount of earnings that return. Given these problems, reliance on ROE may encourage managers to make investments that do not benefit the shareholders. As a result, analysts have come up with other performance measures that might have a little bit better measure to make sure that are we truly making decisions that benefit the shareholders. Remember, the goal of finance is to make decisions to benefit the shareholders. So calculating price to earnings ratio and market to book ratio. They gave us this data. They said the price of our stock was $12.17. They said the earnings per share was $1.14. So we get 12. So this stock is trading at 12 times its earnings. And then market to book is the market price of your stock divided by the book value per share. So the equity of 1952 divided by 250,000 shares. And that'd be 1,952,000. But that's how we got to that number, which is 1.56 times. So our market price is 1.56 times book value, and you want that number to be above 1. Ideally, it would be higher than 1. So that's a good sign. Clearly, they're trending the right direction. As usual for most of our ratios, the trend is right, but we're still below industry averages. So we're getting in the neighborhood of where we should be. So market value ratios, their price to earnings ratio. Price to earnings is how much investors are willing to pay for $1 of earnings. So think of it as willing to pay a multiple of earnings to buy a stock. And market to book is how much you're willing to pay for $1 of book value of equity. For each ratio, the higher the number, the better. PE and MB are high if expected growth is high and risk is low. Okay, so the higher those numbers are, basically the higher the expectations are for future growth. So PE ratios and market to book ratios, if you see really high ones, they just know that investors think a lot of good things are going to happen, which may or may not come true. There's more risk in the higher those numbers are. The DuPont equation is a measure using ratios. It's a really handy formula, actually, and it's a way to break down the components of ROE. And so ROE can be calculated by taking earnings divided by your equity, or you can do it this way and say, okay, I can take my profit margin times total asset turnover times my equity multiplier, and that'll give me the same answer. So what I can do is my ROE can be the multiple of these three things gives me the same ROE as if I just did earnings divided by equity. NI is my profit margin, and so I'm focusing on expense control with that. Asset utilization, which is my sales to total asset turnover, and my total asset to equity is my debt utilization. So I'm focusing on those components. So the point is, if I want to improve my ROE, I need to kind of zero in on at least one of these three and make it better, or clearly all of them also. But the better I get at any of these three components means the better my ROE will become. And so we can just take those three ratios, multiply them by each other, and get the ROE number. Okay, so it's just breaking down ROE into those three components, which allows management to see if we make changes in one of these three components, how will it ultimately impact ROE in total. Okay, you can just see they did the same thing here for 15, 16, 17, plus the industry average, and you can see how what they ended up with for results. You can see that 17 is trending the right direction, where we had that terrible 16, we get to 13 for 17, still below industry average though, which not a big shock. So once we've got a set of ratios established, the next thing that we can do is kind of play the what-if game. That's what's nice about financial statement analysis, is we can ask ourselves, if we can make some changes, some policy changes, some accounting changes, some financial decisions that might improve the ratios, how could we go about doing that? And if we can achieve the goal that we want to accomplish, how might the ratios look like now? And so you can see here, they're calling this an example of the effect of improving ratios. And we've got total assets on the left, and we've got total liability and equity on the right. And it says here, my sales per day is 19,275, and it says, how would reducing the firm's days sales outstanding to 32 days affect the company? Because remember, that was the industry average. So the question is, if we could accomplish the industry average, then what? Okay. Well, that means that we're going to be receiving cash faster. Okay. So reducing AR will have no, and assuming we can do this without impacting sales, that's the key thing. So how can we take the existing account receivable turnover 45 days and get that down to the industry average of 32, basically freeing up 13.6 days of cash. We'd get our cash 13.6 days faster, which means our cash balance will go up, and we can now have more cash on hand to pay our bills quicker and so on, and potentially to reduce the need for us to borrow money in the short term. So the key, though, is if I make this change, I have to be able to make it without any negative impact on sales. So remember that I'm potentially selling to poor credit-worthy customers, so I've got to be better at working with them. Or maybe I just got lazy customers who just know there's no consequence if they don't pay me on time. So I got to be better at that. So it's kind of a fine line when you make that kind of a decision. How do I reduce that number but not negatively upset my customers also? What can be done with that new cash? How might the stock price be affected? So, clearly cash will go up in our scenario here. You can just see that we're looking at going back to here the original on the left-hand side, the original numbers, and then I go ahead and I make my change, and I have more cash now. That's kind of what they're saying is. What can we do with that new cash? How might the stock price be affected? Of course, I can pay down some of my current liabilities. I can get those taken care of. That should improve my stock price. Some of my current ratio would improve. A few other ratios would improve. That would help my stock price. Ultimately, if I'm even using the extra cash to pay off some of this debt, I've got less debt expense now, or interest expense now. I've got more profitability, and that should improve my stock price. Okay, so as cash frees up, I can repurchase stock, just take it off the market, therefore I don't have to pay dividends on it anymore. I could expand my business without having to borrow. I could reduce debt. All of those things would reduce our stock price. Now, ratio analysis is not perfect. Just knowing that's good. Knowing what the limitations are is definitely helpful. Sometimes comparing your company's results to an industry average is very difficult to do. Some companies have many big divisions within them that each division is really different. Disney is a great example. We all know what Disney is, but they have ESPN, they have ABC, they have movie studios, TV studios, the theme parks, cruise lines. So they're all very different businesses under one umbrella. So that makes comparing a little bit more difficult. Remember that also the second bullet point, that GAAP accounting, generally accepted accounting rules, says things have to be done a certain way. However, companies have choices when it comes to applying GAAP. There's 4 different methods for applying depreciation, for example. That could distort results. If I'm comparing my company to somebody else, and we're using different depreciation methods or different inventory accounting methods like FIFO and LIFO. All of those come into play that might have some distortion in comparing the numbers. And sometimes it's hard to tell if a ratio is good or bad, the results of it. And so there's limitations. Just knowing what those are helps as we do an analysis. So also it says average performance is not necessarily good. So just getting to the industry average doesn't really necessarily mean that we're doing great. There might be that might be the lowest benchmark. We want to achieve better than the industry average. Seasonality can definitely distort ratios. At what point in time are you pulling numbers from a financial statement? Is it right before busy season? Is it right after your busy season? Clearly in retail, we know busy seasons in the fall leading up to Christmas, and so those kinds of things get into play too. Some companies do what they call window dressing techniques. Is before they do a ratio analysis, they make some decisions on their books to make the numbers look a little bit better than they really are, and inflation could potentially distort the numbers also. And of course, whenever you're doing a ratio analysis, you have to consider the qualitative stuff. So ratios is very quantitative, and overall this class is very quantitative, but you still have to be thinking, what are the qualitative things to consider in analyzing a company and looking at ratios? So how much of the company's revenues come from just one customer or one product line? How much do we depend on one supplier? How much risk is there when that's the case? You know, if more than 50% of your revenue came from just one customer and the customer were to just walk away, you know, we're going to be in a world of hurt. So things like that are good to know. What percent of revenue comes from overseas versus domestic? Clearly there's more risk when you're relying on overseas business. What's the competitive environment? How much competition is there in the industry? Is industry attractive? Will other industries come into it and take your space and potentially have to be fighting off rivals all the time, which is expensive because you have to do more advertising, more marketing, you might have to cut prices, your margins might thin. What are the future prospects of the company? Is it in a growth industry, in a stagnant industry? And finally, what's the legal and regulatory environment of your industry? Unfortunately, we're living in a time period where there's a lot of regulation and constantly increased regulations and increased regulatory environments, and that forces some companies just to lose. They end up going out of business because of that. So all those things come into play on the qualitative side. So don't just do a quantitative analysis and say, yes, I've got this company figured out. You have to look at some of the qualitative stuff also, which you can only get by reading about the company, doing a deeper analysis than just the numbers. I should also mention that page 123 of your book has a list of all the ratios. So if you just need a one-stop shop to go and find the ratios, page 123 is where that you would go and look. And then always at the end of every chapter, there's some good review. Pages 129 and 130 have what they call the self-test questions and problems. The answers are in the back of your book, in Appendix A of your book. And then they've got review questions for every chapter. I've given you the answers to the review questions, so if you want to read those questions and then think about what the answer is, then go and look at the review questions I gave you. That'd be a great way to just kind of do a self-test and make sure, do I understand what's going on with this? Okay, so I'll wrap it up there. If you have any questions, just let me know.